I'm Keith McCullough, and welcome back to the Investing Summit. That was a pretty punchy back and forth I had with Lakaya. He's a beauty. He's really good at what he does, so pay attention to who he is. Like I said, read his books. He's great. We have a first-timer here at the Investing Summit. I'm excited to welcome Michael Cannivet. Thanks for making the time.
Happy to be here, Keith.
The Hedgeye Nation knows Michael because I've cited this book, I think, 3 or 4 times now in early looks. So, you know, the 4-minute retirement plan. So we'll spend time on the specifics of your book. But first, I just wanted people to get a chance to know you. You know, like Simon Sinek's book, which is, let's start with why. Like, people can tell you what they do, how they do it. But why? Like, why are you doing this, Keith? Why are you doing this, Michael? And you started your own firm. You know, it was certainly not a risk, and you did it for a reason. So why'd you do it?
I did it because I've been training for this job my whole life. I really think my investing career started in my childhood. And I talk about that in the book a little bit. Yeah. My grandparents started teaching me about financial concepts when I was 7 or 8 years old. I could explain what a stock and bond was because they taught me financial vocabulary at a very young age. And so I was always, comfortable with financial topics. Yeah. When I got into high school, I won a regional stock investing contest, got a letter from the governor who later went to jail. But it was still nice to get the letter.
Yeah.
And then when I went to college, I was a student at Georgetown University. I studied government. I thought for a brief moment in time I wanted to be a lawyer, maybe work on Capitol Hill or something like that. But then I did an internship in between my junior and senior year at a venture capital firm in Boston. That really changed my life because that's when I really fell in love with investing. Mm-hmm. It reminded me of collecting baseball cards when I was a little kid. In the 1980s, you may recall, baseball cards were a really big deal.
Big time.
My favorite day of the month was when the Beckett monthly price guide would come and I could see all the little arrows up and down on the cards. And so I used to study statistics of baseball players when I was a little kid and go to the card shows and haggle with the dealers and try to get deals. So I think I've always been interested in investing. When I got out of college, my first real job in the industry was working at Fisher Investments. I worked for Ken Fisher as an equity analyst. That was a wonderful experience. Not only did I learn how to think about markets, but I learned how to communicate with clients. Because when I was an analyst, I traveled around the country doing investment roundtables. And I started doing that at an interesting time. It was 2008. So that was a tough period in the market. And it was also a tough period when I very first started in investing because I started my internship at that VC firm was in 2000 in the summer, just at the apex of the tech bubble. And having seen the baseball card bubble blow up, my cards are still worth what I bought them for in the 80s. Because they printed.
They probably made a comeback though post-pandemic, right? Those cards.
Some of them are coming back, thankfully, because now they're printing so much money that anything that's a scarce asset goes up in value, including collectibles. Mm-hmm. But I noticed how when they printed too many cards, that impacted the market. Yeah. I noticed in the tech bubble how when they printed too many shares of tech stocks with the IPO supply increasing like it did, that created a very tough environment. It's very hard to get my first job out of school because nobody was hiring. Mm-hmm. And then 2008 came along, and I happened to be covering consumer staple stocks at the time. I wrote a book in 2009 about that for Fisher, and I noticed how there are certain times in the market that are clutch time, and that's a bear market in my opinion. I saw what that looks like in the early part of my career.
And you saw it in the eyes of investors because you're on the road and these people are losing money, right? And it's painful, the real world.
It is.
In clutch time.
If you're in an ivory tower making investment decisions, it's different than when you go and you look somebody in the eye and you see that pain and that fear. And you realize that this is an important job we do. These are people's life savings. And so I just always wanted to craft my investment process and then eventually decided I wanted to build my firm around the idea of, there's like, it's kind of like a fourth quarter in a basketball game is clutch time. Mm-hmm. One of my favorite players was Kobe Bryant. Before that, Michael Jordan, because I'm originally from Chicago. And those guys always rose to the occasion at the end of the game when it was on the line. And I made a decision that in bear markets, that's when I want to really be at my best. When markets are at their worst, I want to be at my best. And so I built my investment process around that idea. And I started my firm a few years later. It was after I actually went from Fisher to a smaller RIA firm in Newport Beach that was just getting going, and the founder had a good track record, wanted to meet somebody that could help him grow the firm. We worked together for 7 years to do that. It didn't work out like I thought it would. In some ways, it worked out wonderful. We grew the firm about 500%. I got to establish my credentials as a portfolio manager. I got to manage my own strategy, ranked top 1% in the eVestment database for 4 years. And despite all that success on paper, I got fired one day on a Friday, totally unexpectedly. And I thought of you, Keith, when that happened.
Been there, done that.
And as disgruntled as I was over the unfairness in my own mind, because I couldn't understand we're succeeding on paper, why would this happen? And what I concluded after thinking about it for a while was that my partner and I just had different stories about where we were taking the firm. I was supposed to be his successor, but for whatever reason, he wasn't ready to retire on schedule like we had talked about, and I think I just somebody that he needed to remove from the situation at that point. And whether it was fair or not, I decided to, after 6 days of thinking about it with my wife, telling your story about how you turned that negative into a positive when you started Hedgeye. I had little kids at the time, just like you did. It was scary to take a step back in my income when you got little mouths to feed. But I decided that the mission's more important than my stress at that moment. So I decided to start my firm, and here we are.
And you've done really well since. I mean, especially in the clutch. 2022, I was looking at your numbers, and you're long only, right? It's not like you can, short things and make money, in a collapsing market. And what were you in 2022? You were down a little bit.
Down about 2%.
Yeah, who wouldn't take that, right? And especially, you're competing with RIAs and high net worth, types of 60-40 type solutions, and. Before we get into the power of why on that and writing that book, it's like I think it's extremely powerful, and it's super humbling for me to hear about people like you, and I hear it. I wouldn't say frequently. There aren't a bunch of Michael Cannivets running around, but I do hear it enough where it's actually all the things that we're doing here and have been doing have a big impact, and that's the most humbling thing you could hear. Right? Yes. And it's also the most rewarding because I'm like, wow, look at what this guy's building. And there are some components of what we've done that have helped him. And that's what we're trying to do, right? We're the people that run around saying they know everything, we don't know anything. We're just building the process on the back of giants, right?
Yes.
Like fractal math, thanks for coming out. Mandelbrot, nice to see you. So these types of things for me are, like I said, it's just powerful and humbling at the same time. So thank you for sharing that.
Thank you.
Yeah, you didn't have to give every detail, right? But you did, and that's a personal thing, and that is powerful in terms of why. You're like, I can do this.
Yeah, I decided that one of the things I like about Hedgeye is that I think you've taken the core values from your athletics career and you've transferred them into your professional career after that, and I think that's really powerful. So one of the things that I write about in the book is how to write the story behind your financial plan.
Yeah, I like that.
Because I think, we're so focused on numbers in this industry, we lose sight of the narrative, and the narrative is really more foundational, in my opinion, because that's your why. And it's not just me and my firm or you and your firm, it's the audience members in their own lives. What's their why? And do they have a financial plan that articulates that in a way that's personal to them? Because there's a lot of cookie cutter solutions in this industry that people are trying to push out there, right? And as I like to say, people are not cookies, we're complicated. Okay? So cookie cutter solutions just don't work for everybody.
I got to get you on the macro show because I need some smoothing over to do. Sometimes I'm a little too rough around the edges on that.
I like that you cuss. It means you're authentic. I got to turn it down a little bit when my kids are in the car, but it's okay. The story behind everyone's financial plan is something that I think is very important. It's very personal, and if we're not real with ourselves, it's hard to achieve what we really want out of our life. So we can't run away from our past failures. We can't. All we can do is pick ourselves back up again and start again more intelligently. And turn any negative that you've ever had financially. If you got burned in the stock market, that doesn't mean the stock market's a bad investment. It goes up 96% of the time over 10-year periods over the last century. So a lot of people just have these scars from the past and they carry them into the present and the future. So what I want to do is I want to create a wealth management program that helps people write a convincing story that empowers them to do the right things financially, but to use their money also to live a better life.
First and foremost, welcome to Hedgeye Nation. Make no mistake, my number one goal is to help you preserve and protect your hard-earned capital. Who helps you with that? How many people have actually helped you preserve and protect that capital? They can't. They don't have a process. You need a better way. We need to get better each and every day. There's a lot of baggage out there. There's the old wall, a lot of bullshit. There's CNBC. That's not who we are. We have a process. We're going to help you get better. We have a team of over 40 analysts that are going to help us do that, and I'm looking forward to it.
Hedgeye founder and CEO Keith McCullough's long-awaited new book, Master the Market, is available now. In this 52-page ebook, Keith McCullough distills decades of Wall Street experience into actionable insights. Discover how to navigate market cycles, avoid major losses, and invest with the confidence of a seasoned pro. Download your free copy right now. Go to hedgeye.com/book. That's hedgeye.com/book.
If you can't start with the truth, like, okay, this happened to you. You know, this was 2008. I was sitting across from you. I didn't know who you were, but there was an immeasurable amount of pain in your eyes. Like, do you want to go through that again? Okay, well, then you can't have this kind of a portfolio. Okay, we need to make the decision that's for you. Well, maybe you're somebody who started investing in 2020 and you own the bottom. Yep. Well, that's different, right? Let's maybe think about hedging SPY at a bare minimum, but it's a very important thing. On Wall Street, it's most typical that God puts you on the earth to start at a certain date, right? Yeah. So, the greatest bond bulls of all time, they're born right at the very bottom of the bond market, right? Into the business. I'm born in 1999, we're into the business. First experience, crash. Second experience with crash. So that's the Gen X experience. But I appreciate you starting with that. A couple things that, and we'll get into kind of how you think about, not kind of, you explicitly and from a process perspective, think about portfolios very specifically. But I think here's a good point that you make in your book. You say most people are biased towards activity, but the most important activity is deciding when to direct our attention. What do you mean by that?
Focus on the things that count. Einstein, one of his favorite quotes that I have in the book is that if he had a complex problem to solve, he'd take 55 minutes thinking about the right questions to ask, then only 5 minutes to solve it. Mm-hmm. Because a lot of the problem, I think, is how we frame things. Mm-hmm. So to focus on what's most important is to focus on the most important factors that you're trying to, that are relative to your goal that you're trying to achieve. I'm a big fan of the 80-20 principle, for instance. 20% of our actions drive 80% of our outcomes. But guess what? If we're not backtesting our actions, or at least using history as a guide on how we're going to navigate towards the successful future we envision, we're just guessing. And so that's one of my feelings too with investing. If you're not backtesting, you're guessing. And so I'm very big on empirical research to figure out the right process for me and my personality to achieve what I want out of my life. Mm-hmm. And I try to help my clients with the same thing. If you don't get your asset allocation right, for instance, that's a big driver of your long-term returns in your portfolio. Mm-hmm. So it drives me crazy when I see like these YouTube videos where there's all these thumbnails of these people like, these scary pictures, and they're trying to scare the heck out of their audience. It's like, wait a second, like, humanity's story is one of progress, not just everlasting pain. Yeah. But because there's so much clickbait out there and trying to scare us all the time, we lose sight of sometimes like the easy things that we should be doing to get ahead over time.
Well, it's how they get paid. The reason for everything, almost everything, unfortunately, is how people get paid. Yes. Like, you and I get paid to make sure people don't lose their money. Like, that's rule number one, right? Exactly. So when when you wrote that, it came to mind, that it's the particular thing that happens at the particular point in cycle time. That's, what are you paying attention to then? Tomorrow, are you going to be paying attention to, hair on fire macro tourists on CNBC talking about how dovish the CPI number is? Or are you going to realize that it's been 27 months? Guys, show slide 36. That means quad, when you're in quad, as you would know, when you're in quad 4 or quad 1, you have disinflation. Yes. 9 straight quarters. And McFly is going to wake up tomorrow thinking that that's the new trend, right? Whereas we want to pivot at this particular time into owning inflation. That's quad 2 and 3. Quad 2 and 3 are a function of having 27 months, 9 quarters of quads 1 and 2. How have you thought about that? Like, in terms of, I know you think about the quads, but how do you think, because you clearly made a turn coming out of 2021. 2021 was just the best of quad 2s, It was the best quad 2 in the history of quad 2s.
Yes.
We were even long GameStop before GameStop became a thing in quad 2 and said, we don't care how high it goes, we think it's going higher. Like absurd things were happening in 2021, but they should have been happening because the economic conditions perpetuated. Print more money than God could, call yourself God without actually calling yourself that, and here we go. It was full send. But you made the turn. So how do you think about that, like within the lens of the quads?
Well, you helped me make the turn, so I thank you for that, you and your team. One of the things I love about Hedgeye is that you're very vigilant on the risk management front. I don't know of any big market downturn you've missed, so part of the reason I watch the macro show as much as I can is just to make sure I stay in tune with always being vigilant on the risk front. But I think one of the things that is really important when you think about what's important and what's not, like people get so hyper-focused these days on the Fed, right?
Yeah.
And we can focus on, are they going to cut 25 basis points or 50 basis points? And the media portrays it a lot of time like that's the most consequential decision in markets. But I think sometimes we lose sight of something that's bigger picture, even more important than that. And that's that they obviously have an inflationary policy long term. If you think about where we are right now, the economy is fairly stable, unemployment's low. And central banks around the world are cutting rates most aggressively. Like I think this is the third most aggressive global rate cut cycle in quite a long time. And it's because there's only two ways out of a debt trap if you're a government. You can do austerity or you can do inflation. Inflation's easier to sell to voters even though they don't like it.
You think? Can you imagine if somebody was running on austerity?
Good luck, So the incentives matter, as you said. And the way the Fed operates, I think the most important thing to realize is that, there's a lot of money being printed. In 2021, or 2020 really, we shut down the nation's supply in a lot of sectors. So if you took Econ 101, which I would hope a lot of these hundreds of PhDs of the Fed have done, they should understand supply and demand curves, right? So if you reduce supply, why the heck would you print 26% more money in the face of that and not expect a big outbreak of inflation? This is such a fundamental thing to me, and I don't understand why more people don't focus on that. And why is the same person in charge of the Fed that did that and then called inflation transitory? There's no accountability. Mm-hmm. And so I think that what's happening is there's a long-term inflationary plan at the higher levels of society, and a lot of people haven't gotten the memo. I don't think the market's even woken up to it yet.
The market is constantly, and we'll get into that. That's the second point I was going to pull out of your book. But it's Daniel Lacaille and I just had this conversation. It's by design that they have it that way, right? And that's why people feel the way that they do. Yeah. They're like, the elites are lying to me. They're doing it for their own incentives. That's why we have a K-shaped economy that continues to widen. If you're on the right side of the K, you're part of the group. If you're long inflation, you're part of the group too, which not everybody on that side of the K is part of the same community. Nate Silver just called them, the difference there is the difference between those who are in the village and those who are in the river. Yeah. He says, look, I'm a poker player in Vegas, I'm in the river. And he's using a river card as a metaphor. But the village is people who need status, inside information, the eliteness of it all, to continue to be rich and get richer and more powerful in terms of political impact. This pisses so many people off. So many people that are watching this. Yeah. And it really pisses off the ones that are in the village. Because they're like, this guy's got to shut the fuck up. Right? Meanwhile, I have all these subscribers, I have people like you have all of your clients, and we're all talking about it. Mm-hmm. And the Fed doesn't want to talk about it. Right. They want to put this thing over here.
Exactly. And so I think long term we're in an inflationary cycle. I think that's pretty evident if you look at the big picture. But I think in the between here and there, you got to trade the chop. Yep. And that's what's so good about what you do. You help diagnose when's the time to own the inflationary assets, and then sometimes they get overbought or something changes, and the short-term cycles aren't always the same as the longer-term cycles. Right. So you got to understand the long game or the tail. You got to understand the trend, and then there's the trade too. The 3 time durations that was the most important thing I've learned from you over the years. Is just to think of the market into 3 different time zones and to not marry your long-term opinion to your short-term tactical opinions, because they're different. Yeah. You got to keep both, and you got to balance them in your mind, and it's hard sometimes.
A very good example is just that. I mean, if the fiscal, it's not just the Fed. I mean, obviously you have the most fiscal spending in the history of fiscal spending, and by both parties. If you have that, long term is inflationary, right? The cumulative inflation is undoubtable, but the rate of change of inflation has slowed for 9 quarters, right? So those are 2 different durations, long-term tail versus the trend, right?
Yes.
And some people get really lost on that. But the people who are really good at this, man, I don't care if you run $100 million or if you run $1 trillion. If Rick Reeder was here, sitting right there, he would have the same view. He'd say, Keith, I love your content. I love the rate of change analysis, et cetera, et cetera. He is paid to get these things right. It's interesting, right?
Yeah.
$1 trillion managers to, I don't care if you run your $1 million, if that's all you have or less. I mean, it's not about the size.
Yeah.
It's about the people who are successful are assuming the position of higher for longer inflation. And that's just right now just turning. Have you thought about, I mean, you're correct me if I'm wrong, but you're not buying physical gold yet, are you, or anything like that? You're using equities, fixed income, et cetera, to build your retirement account?
Yeah, I think in terms of how I'm playing inflation, I think one of the problems too in the market in general is the market structure, as you know, has changed quite a bit.
Yep.
It's interesting to me that since inflation bottomed in May 2021, materials is, you'd think, an inflation beneficiary,
Yep.
but it's underperformed tech.
Yep.
Growth has still outperformed value since then.
Yep.
A lot of the things that people said, like once there's an increase of inflation and interest rates, a lot of people expected these trends to change, but the market's so passive nowadays that a lot of people just buy what worked well in the past, and I don't think a lot of people have woken up to the fact that we got a 40-year breakout in long-term bond yields. That's a big trend change. I'm not going to fade that unless there's really convincing evidence that I should.
Yeah.
I just don't see it yet. So I think it's good to own things that are being systematically underinvested in by the passive machine. Despite inflation breaking out, oils and energy stocks are still only 3.5% of the S&P 500. So I like energy stocks. I like ExxonMobil. We're systematically underinvesting in copper mines. I like Southern Copper. So I like some of the plays that I know are going to do well over time, but I still got to trade them because the thing I hate about commodities, because I'm a risk manager at heart, I hate how volatile they are.
Right. Well, especially in Quad 4. We just had the last of the Quad 4s. That's when commodities get zonked, and they did.
Yep.
And I get that feedback a lot from, well, that's where the bigger clients, they do have a much more difficult task than me and you. Like when I put up my long-only portfolio every day, you need your head read to do that, by the way, I understand that. But I show people every position. Some people are like, I don't know if he's up that much. Like, just put the positions in and size them at the minimums and tell me what the returns are. It's a trivial thing, right?
Yeah.
That's more like haters and trolls are like, it could never be true, right? Hedgeye could never be true for them. But we do have institutional clients who'll say, hey, look, if I get into energy stocks, I can't just get out 3 months later.
Yeah.
Right? But that's actually what was required to risk manage Quad 4 and Q3. Because the worst place you could have been was energy, and now the best place as you get into Quad 3 is energy.
Yeah,
as
exactly.
a function of it. So on that, like you have this other great point that you say that every long run is a series of short runs. And correct me if I'm wrong, but that was used the Bannister story to illuminate that. Can you expand on that?
Yeah, so the reason my book's called The 4-Minute Retirement Plan is because it's inspired by the story of Roger Bannister. When I went through my hard time in my career, it happened to be the same year that he passed away. I read his obituary, and it really inspired me when at a point I was down. And I loved it because it's a comeback story, for one. For those who don't know, he competed in the Olympics in 1954. He got 4th place. Nothing burger on the medal. But he wasn't ready to retire on a down note. He wanted to do something better before he stopped running, and he wanted to run the first 4-minute mile. So even though he was 25 and a medical student at Oxford, he only had 30 minutes to train during his lunch hour, which is not as much time as his competitors. He looked at the race and he deconstructed it, and he started with a positive story. A lot of people thought it was impossible to run a 4-minute mile because the record had been 4 minutes and 1 second for about a decade. And as person after person couldn't get over the hump, people developed all these strange theories. Maybe it's not possible, maybe the human body's not designed to run that fast, all these ridiculous theories. He was a physician in training, so he knew it wasn't a limit of the body, it was a limit of the mind. So he said, this is possible, and all I'm gonna do is chunk this race down. 4 laps is a mile. If I run 59 seconds each lap, guess what? I'll achieve my goal. So he practiced running 59-second splits over and over again. That's all he did, the simplest strategy you can imagine, but he married that simple strategy with a positive story. On race day, he had 2 pace runners that ran alongside him. Their job was to run 59 seconds, so he didn't even have to think about the race. And it's good that he had those pace runners, because when he was running, he thought he was going too slow. He wanted to speed up, he felt the urge to, but if you're a distance runner, you know that you gotta preserve your stamina. So he stayed at the pace, and at the end, if you watch the video on YouTube, you see he kind of like is right up at the front of the lead, but he's not leading most of the race. He only takes his Bannister burst and goes ahead of the pack at the very end, and that's because everyone else was slowing down and he was still going at the same pace.
Well, that's interesting because the pace car, you said you had pacers. Because you couldn't, by definition, couldn't just have one pacer because they would run a less than 4-minute mile. It's amazing, multi-factor. Multi-duration, like just think about it differently.
Chunking it down.
Chunking it, that's exactly, when I look at markets, that's exactly how I look at it. I look at it and that is fractal math.
Yep.
The difference, there is no difference. If I look at a fractal pattern at this level of scale, and then I zoom way out, it's still the same pattern.
Yeah, anybody that doesn't believe in fractal patterns, I encourage them to subscribe to the DeMark indicators and look at them on a few different time zones. Like, 'cause you can look at DeMark indicators on 5-minute, 133-minute, daily, weekly, monthly, and you'll see that when there's 13s, markets tend to exhaust and reverse, and they do it on every single time scale. So that's just one of the tools I use. I use your risk ranges and follow you as well, but I've always combined the two a little bit in my process. What I love about Hedgeye is you allow people to take your inputs and combine it with other things and make it their own to achieve what they're looking for, but fractal patterns are everywhere in the market. A lot of times the media will frame why the market went up and down in a given day, and I know journalists have to write stories, but it's preposterous to think that the S&P 500 did this or that because of one story. There's millions of independent people making decisions based on millions of different inputs. It's a complex adaptive system. You need to chunk it down to what counts and what matters. So owning the best stocks in a bull market is one of the things that matters. Shorting or being out of the weakest stocks in a bear market is one of the things that matters. That's one of your beliefs as well. And not being religious about any one input, I think, is really important.
Yep.
I was raised in this industry by, to think like Ken Fisher, and he was my first mentor. He taught me that it's not about having the best religion in this industry. It's not just about being a growth investor, a value investor, a technical trader. You can combine anything that works over time and make it your own if you package it together intelligently. But it's important to be dynamic. It's important to be flexible in your thinking and keep evolving. I've got a multi-factor model I built in 2012 that's really good. It backtests fantastic, and it's done very well over the last 10 years. But it's degraded a little bit the last few years because I think the market's changed. 30% passive share of the market in the equity space when I started and built that model is different today than we have 60% and rising.
You think?
So guess what? That means momentum and growth factors and size are more important variables now than they used to be. So I have to keep playing the game differently and evolve as you're doing, and that's one of the things I think everybody should try to do.
Yeah, I mean, we do it in every other profession.
Yeah.
Can you imagine these global climate change self-perceived experts just assumed a static position? They wouldn't have a job. I mean, you can't, the whole point is that the world's constantly changing, and it's a nonlinear dynamic system, which I love how you put that. And interestingly, now that he's, I guess, retired to a degree, Steve Cohen, he probably wouldn't care if I said this, but I guess I'm going to say it anyway. But, some of his guys that I know well, because, we're here in Connecticut, Harry Schwefel's the CIO, he's my former partner of Point 72. They'll combine, they'll do exactly what you do. Steve loves DeMark as a signal, and many combine the risk range signal with the DeMark signal. They're not the same signal, they complement each other. So I always say to people, and we have a lot of you that are watching this that have built your own RIAs, your own asset management firms, you run your family office. Nelson tweets about it all the time. He's like, look, I built my own risk range model. If you actually go into some books and read Mandelbrot, you're going to immediately realize that what Michael just said is 100% true, which is most of the time, CNBC, the market move is called Brownian motion. There's nothingness. You don't even need anything to explain it. It's nothingness. No, it's nothingness. But if you're paid to create reasons, paid advertising dollars, again, it's how they get paid. So again, when I look at it, again, that's humbling too. when somebody can say, okay, just like I did. I took Mandelbrot's Hearst component. It's like, let's screw around with this over here. Let's work this over there. And over the years, I continue to tweak it, right? I mean, but you can go into Mandelbrot's book and find basically the grains of sand that'll lead you to my calculations, right? I mean, but I don't give them away, and I don't have to, right? You're doing fine on your own, right? I mean, you do get the risk ranges, but I mean, it's not a thing that that a lot of people completely understand, frankly. But just to finish on the book, at least one big thing I want to finish on the book. So you have like 4 different laps that you say that we have to make. Like, as I'm about to be 50, so my wife even asks me, like, how are we looking in the retirement account? I'm like, well, look at Portfolio Solutions. But really, like, I mean, I love how you did it. You have these 4 laps. So can you go through them?
Yeah, sure. Well, I think the thing that's hard about retirement planning, it's the #1 financial riddle most people are trying to solve up and down the wealth spectrum.
And sometimes way too late.
Yeah, look, if you think you're going to start retirement planning at 62, retire at 65, good luck. It's a long race. It's a distance run, just like the mile. And so what I wanted to do is deconstruct the biggest financial riddle most people are trying to solve, one that many people find overwhelming. I think the reason people find it overwhelming is because it's multi-factor, multi-duration.
Right.
There's not just one component of a retirement plan. There's a few of them. So what I decided was I'm going to help people deconstruct the race just like Bannister did, 4 laps. And I came up with there's a savings lap, an investing lap, a lifestyle lap, and a legacy lap. And I contend that if you don't cover each of those bases adequately, you're not going to be where you want to be. First off, if you don't save any money, you have no money to invest. So you got to learn how to save money. It's not that hard to do. If you have an income, you can follow the 50-30-20 budgeting formula and start saving money. I tell a story about a guy named Theodore Johnson who worked at UPS, thought he couldn't get ahead. He started following that formula in his own way. It worked out beautifully. But
that, by the way, is totally understated, like in terms of its importance. If you have generated wealth, right? Like if you've generated I'd call it, let's just say, a significant amount of wealth. You know, my wife would. So my quickest answer would say, well, just go look at the savings account alone. I mean, which is compounding now. You know, actually more like 5.5%, depending on what the money market rate is. But it's just like, you can just have X% of your hard-earned nut just sitting there working for you for the rest of your life if the Federal Reserve just leaves interest rates alone, which they're not going to do. But that, a lot of people don't do that.
Right.
A lot of their entire generation was taught not to save because the interest rate on that was 0.
Yeah, exactly. And with inflation, it's harder to save, but you can still get there if you prioritize it.
Right.
But then once you save some money, you got to invest it well.
Right.
Because if you invest it all in a bad crypto investment or something crazy and it disappears, you're not getting anywhere.
Right.
So you got to save well, you got to invest well. Those are 2 of the laps. And I take people in the book through different strategies they can use. I'm like you. I'm not of a mindset there's only one way to save or one way to invest. There's a lot of time-tested, proven strategies. The best thing to do is to find the thing you're most comfortable with and can stick to, because you can have the best strategy in the world, but if you don't stick to it, it's not going to work.
100%.
So you got to invest well. And then on top of that, let's say you're building a big financial war chest, but if you're not using that to live a better lifestyle, what's the point? Right? And a lot of people are good at making money, but they're not good at allocating the money in ways that are meaningful to them and bring them joy and really improve their well-being. So that's one of the important laps, and there's strategies for that, like choosing where to live or the different check boxes that you want to have at different stages of life. You know, I think the retirement race is a great one to start in your 20s, but if you don't, it's okay, you can catch up. It's just you got to know how to do that. So I take people through that.
And there are a couple good rules in that chapter in particular that I wasn't aware of. I actually never thought about it that way. But these are, like you said, time-tested rules of retirement. So can you just walk people through it? If you take X amount of what you're going to spend every year, and like just that equation, I can't even remember what it was called.
Yeah, well, one of the things I talk about is you should have a present hedonism budget.
There you go.
This is a unique idea.
Yeah, that was a good part.
So the 50-30-20 formula is take 50% of your money and use that for your needs, the roof over your head, the food on your table. 30%, call it your fun money budget. Yep. That's for discretionary things like clothes, cars, trips, whatever. And then 20% long-term savings for retirement or other goals. But within that 30% budget, I think a lot of people don't really think about the story of their life, what makes them truly happy. That's why I think you need to write a story behind your financial plan to really get clear about when you've been happiest in your life. What were the common threads when you were on track and thriving? Where were you? Who were you with? What were you doing? What are your happiness triggers? What are your core values? Those were all components of scenes from your story in those periods of your life. If you contrast it to the darker times in your life, what I've found in my own life and with a lot of my clients is that the core values aren't being honored in the dark times. The happiness triggers aren't part of the story in the dark times. But we're not always actively managing it because we're not actively managing our stories, Keith. And we need help with that. And so I think that's part of the evolution of the industry I'd like to see is if we're going to combine wealth with well-being, we need to have a process for that. And that's what I'm trying to help with. And so with your lifestyle, you know, for instance, I golf like you do, but I'm not the greatest golfer, and it's not my favorite thing. And I looked at my budget a few months ago, and I realized how much I'm spending on my golf membership relative to the joy I'm getting out of it. I'm like, I'm wasting so much money. I've played golf like 6 times since 2020, and I figured I'm paying more than the Pebble Beach greens fees for my course. It's not Pebble Beach. It's a nice course, but it's not Pebble Beach. So I'm like, I need to recalibrate this budget and actively manage this better.
Yeah.
And so I need help with it too. But that's why we all need coaches. Somebody that understands their story and can coach us. I'm doing the right.
First and foremost, welcome to Hedgeye Nation. Make no mistake, my number one goal is to help you preserve and protect your hard-earned capital. Who helps you with that? Like, how many people have actually helped you preserve and protect that capital? They can't. They don't have a process. You need a better way. We need to get better each and every day. There's a lot of baggage out there. There's the old wall, a lot of bullshit. There's CNBC. That's not who we are. We have a process. We're going to help you get better. We have a team of over 40 analysts that are going to help us do that, and I'm looking forward to it.
Hedgeye founder and CEO Keith McCullough's long-awaited new book, Master the Market, is available now. In this 52-page ebook, Keith McCullough distills decades of Wall Street experience into actionable insights. Discover how to navigate market cycles, avoid major losses, and invest with the confidence of a seasoned pro. Download your free copy right now. Go to hedgeye.com/book. That's hedgeye.com/book.
One of my buddies I was golfing with this summer, and I couldn't believe like how happy he looked, right? It wasn't just because he went through a divorce, but it's just that people go through a divorce because they don't want the darkness anymore. They don't want to feel that way anymore. But he just genuinely looked happy. And you're happy when your friends are happy. I am. And golf courses, you get an ample amount of time to see that. And I said, he's like, I said, what happened? Like, what did you do lately? Like, he's like, well, I canceled my golf membership. That's why I'm playing shitty here. And he's laughing. He says, but I bought a boat. And he goes, I spent a ton of time with my kids on this boat that I would ordinarily be spending on the golf course, you know, no offense, Mucker, but with you, like, or with my friends. He's like, I really, at this stage of my life, enjoy being with my family. I know they're going to be leaving, you know, our house soon, going off to college. And he's like, I'm just really happy about that. And it's like, it really is a choice. And people, you really tap into that. You also tap the legacy lap. For me, now, you made me think about the actual structure. Like, I already have a family trust, right? You go through multiple ways that you can give back, you know, and how to structure that. I don't think people spend enough time teaching people that. I know people, like clients and friends that have some real wealth. They're constantly asking me for things like that. And you put it all in one book, which is really good.
Thank you.
Yeah.
I really appreciate it.
Yeah. So what, like, maybe something on that front, like if you let's just say, like, what do you think are the most interesting things to do in the legacy lab?
I think it's important to think about how you want to be remembered. That was one of Kobe Bryant's best quotes that I like. I put in the book, you know, you're responsible for how you're remembered. And you know, we're not gonna be remembered by how much money we have in the bank. It's important to make money. I really believe in capitalism. I believe in financial security and all the good things that come with that. But if you talk to hospice workers, what are people thinking about at the very end of their life? They're not thinking about the numbers in their bank account. They're thinking about, you know, the people they wish they spent more time with, if the chances not taken, things like that. And so I think it's important to think about how you want to be remembered, how you want to give back. It's not just about what we get out of our life, it's what we give. If you want to be fulfilled, you got to learn how to give in a way that's rewarding for you. So I think one way that I try to do that is I try to participate in charities that are personal to me and my story. My youngest brother was born premature by 3 months, had some complications. The toughest year of my childhood was the month that my family lived in the ICU. Thankfully he recovered, but some of the other children weren't so lucky. And that made a permanent impression that changed me, that experience. So that's one of the reasons I'm a wish granter with Make-A-Wish, because I love, love, love going into the homes, and I know what it's like to be a family member. People don't realize it's not just about the sick kids that you should feel sorry for. It's the family members.
The family.
They're feeling it too. It changes everything. So to be able to go in there and help a kid dream of their most authentic wish and make it come true and see the joy on their faces, like that's super inspirational to me. That's why I do Make-A-Wish. And it came in real handy because the day I got fired, I was feeling pretty low, pretty shocked. But I just so happened to have a wish granting party that night.
Really?
For a child who, and I went to that wish granting party begrudgingly at first. I was like, God, I got to get out of this. I'm feeling so sorry for myself. And then I went to that party and I met this family, I met this child, and I realized all my problems were short-term fixable problems. I was so thankful my children were healthy that evening. And it helped me get over my own crap really fast. So charity is really wonderful. You get more out of it than you give. Whether you start a foundation, it's not that hard to start a foundation. You don't need to be a billionaire. You can do it. I give some instructions in the book. One of my clients, I manage a few $100,000 only for an animal shelter, but his mother started this animal shelter 100 years ago. She loved animals. And now he's maintained that and grown I help him grow the pot, and he doles it out to help animals, and it's a good way to remember his mother. And when he's not here anymore, his daughters have agreed to carry on the mantle. And so I love being part of those types of stories because it's a good way to take your resources, take your time on this earth, and make something permanent of it.
Yeah, and it's all about planning that. I mean, people just generally don't know because they don't take the time.
Yep.
But if they make the time, to your point, they can feel a lot better about the world and themselves. If we're right and inflation is higher for longer, a lot of people are going to need our help. Like this is like, for me, that's at least one of the ways to get, like this morning I was saying to Drago on the call, I'm like I'm at a moral crossroad here. It's like I wrote in the Bloody Early Look, buy inflation. Here are 5 ways to buy inflation. And I know damn well that if we're right on that and everyone else buys it too, that the people are going to have to eat it. And that's brutal, right? It is. You don't have to go very far. If you live in Westport, just go to Bridgeport and you're going to see it. And I make sure my kids see it because I want them to understand, like, this is why we do this. We need to help these people. So that I really like that and how you structurally give people a solution to commit to it. Because that's got to be part of it too, is that people with wealth, many of you have wealth, you just haven't made the time, but if you do, or get somebody to help you do it, right? I mean, you're helping people do this, right? So you don't have to do this on your own.
Yeah, because if I can help my client write the story behind their plan, I can also coach them afterwards because I know what they're trying to achieve and why.
Oh, that's awesome.
I know what their why is.
Yeah.
But I need a coach too, because sometimes we get so close to our stories. I tell people, if you think about what makes a great Hollywood movie, is it the finance department? No, not at all. It's the director, it's the writer, it's the actors, and we're all the actors in the story of our life. We think of our life like a movie, kind of, right? We think in narrative. We don't think in numbers. We don't think of our life in a spreadsheet. So it's important to marry the story with your actions as the actor, and it's important to finance it all so you can achieve what you want on time. But it's complex to do all 3 roles, so that's why we need coaches.
Right.
And that's what I think a good financial advisor should be for their client.
Well, if you think like the financial department is like the back alley, I mean, how about the risk manager inside of the finance department? Like that's the most boring person on the planet, the person you don't want to talk to. That's me, right? Like, I mean, so maybe just to finish here, because you also identified some very obvious mistakes that people make. Maybe go through like what risk manager, like it's one thing for me to say, parrot, Munger or Buffett for that matter, and say, look, rule number 1, don't lose money. But it's entirely another thing to know when you're going to lose money if you do some of these things. What are some of these things?
One of the things is investing in stocks with terrible, horrible fundamentals. Ask AMC investors how that worked out a few years ago. Ask the Vanguard investors who, people forget, the moonshot with AMC was not just retail investors online, it was also the passive funds that bought.
Yeah.
Because a lot of the investments that are done today by the passive funds, they don't look at fundamentals, Keith. There's a reason the funds are so cheap. And cheap isn't always better in investing. It can lead to misallocation of capital. And if you buy a company like AMC at the wrong time, it's down like 99% from the high.
Yeah.
So it's not that you have to be a value investor necessarily, but I really believe investing in quality businesses pays over time. That's one of Buffett's principles. The greatest thing about a quality business is if you overpay for it on the front end, it'll grow into the valuation. You're not going to lose all your principal. But if you buy companies that have a lot of debt or negative profits, you can lose all your money quite quickly and suddenly.
Or if you buy an index, like the Russell 2000 was loaded to the gills with this crap.
Yep.
And that's why the Russell's still down 10% from where it was in 2021. Imagine that's your target date asset allocation, which it is for many. Yep. You're like, what do you mean stock market hitting all-time highs? Like that's not, I'm just trying to get back to break even and I still got to be up 11% from here.
Exactly.
So that's a very good point. What would another one be?
Another one would be to, I think, not just chase the sexy stocks that everyone's chasing. NVIDIA is a great company and it's doing wonderful things on the growth front, but you don't have to just own stocks like that. Some of the boring sectors have actually done pretty well over time. Right. I know that because as a consumer staples analyst. And one of the things I found, one of my favorite books that I've read is Jeremy Siegel's The Future for Investors. It's not his most famous book, but it's one that I think is really wonderful. He goes through and he shows what were the best performing stocks in the S&P 500 from 1950 to 2000. And a lot of people are surprised to learn the best performer was Philip Morris.
Yeah, it was.
I mean, a lot less people smoked by 2000 than 1950. But guess what? Philip Morris earns high returns on capital. It never trades at too high of a valuation. So if you reinvested those dividends over the years, the stock has been a compounding marvel.
Yeah.
And if you contrast other companies that grew a lot more, like IBM, they underperformed that one. And 13 out of the 20 best performing stocks in the S&P from 1950 to 2003 were consumer staples and healthcare companies, I believe.
Very good. I mean, I was just going to show that chart. That's why I picked this thing up. I love it when I have a conversation with a pro who's just embedded in their process and their thoughts, and everything that comes out of their mouth is empirical fact, right? I mean, go to slide, you got to dig deep here, guys, on this one, slide 113. And this is showing since 1999, Michaels, right? So, to your point, consumer staples and healthcare are in the top 4. Technology is fun, it's exciting, but it's not the only thing to do.
Yeah.
I mean, actually, if you go to some of the real fun stuff, which are called comms, which are, can be driven by cons, that are also technology, are the worst place, right? Yep. And that's because we've had multiple bubbles completely implode, because it goes back to 1999, fortunately, the analysis, right? So that's a really good point, is boring can be good.
Boring can be beautiful. Turtle wins the race a lot of times. The most important thing in investing is to not lose all your principal and to just stay in the game. Time is the most beautiful tailwind, but you win by not losing. The best investors I've studied all have a common thread. They lose less than the rest of us, and that's why they win so well long term. I don't want to just be a Johnny-come-lately who does really well in one market cycle and then flames out the next one. I want to have a long career like my mentor Ken. He's been around a long time. The reason he's survived and thrived is he's changed and been dynamic and never taken too much risk, and I think anybody can follow that playbook in their own way. But you got to think a little differently than the crowd sometimes. You got to be independent-minded.
Yeah, and you clearly are. So I think that, well, first, thank you for opening up and for writing your book. I mean, it takes a lot to put all that out there, right? You put yourself out there. And that's what I think. I mean, I'm from the future, right? In the future, people aren't going to put their money with things that they don't trust, that they can't understand. They're going to call somebody like you, or they're going to listen to somebody like me, or both, and they're going to have a much better experience, right? So thanks for doing all this and for making the time to come in person. It was really good to meet you in person.
Thank you so much, Keith.
All right.
Really appreciate it.
Thanks, man. Appreciate it.
Definitely.
He's Michael Cannivet. Now you know it rhymes with Chevrolet. Don't get the name wrong. Buy the book. You're gonna learn a ton. Right? I thought it was a great conversation. I'm looking forward to bringing him back. Up next, we're gonna have Murray Stahl talking about hard assets.